All right, we last left off. We're looking at market structures, which you can find on page 211, all the information if you miss it. The number of firms, variety of goods, control over prices, barriers to entry, and then some examples. This is what you want to look at when you're looking at like a structure of a market. So you have a free market, you have a monopoly, you have an oligopoly, and then you have the government. So for a free market, it's infinite. You can have an infinite amount of firms. Monopoly, usually only one dominates the market. An oligopoly, you have less than 5 firms dominating the market. And then the government is the government, so you only have one. So they effectively have a monopoly. The variety of goods, you have an unlimited variety of goods. In a monopoly, you only have a few goods. In an oligopoly, again, you only have a few goods. Like the variety of cell phones that are available, they just upgrade the camera. That's about all they do. And then with the government, it isn't necessarily the variety of goods. It's whatever the market doesn't provide. So a market doesn't provide national defense. It doesn't provide roads. It doesn't provide traffic signals. It doesn't provide. Sometimes it provides parks. Like if you build houses or something like that, usually, the government forces the developer to leave some open space for parks. Control over prices, it's supply and demand. In a monopoly, it's the monopoly. In the oligopoly, it's the oligopoly. They sort of set prices. However, both are subject to supply and demand to a certain extent. It depends on how strong the monopoly is. If there was a monopoly in the gasoline market, it'd be pretty strong because gasoline is pretty inelastic. But with electric power coming into play, the control over prices isn't necessarily as strong as it would be in a monopoly. Gas companies are pretty much an oligopoly. There's only a few of them, and they set to control prices. They actually work together when they refine the gasoline. So like Unical will sell to Shell and stuff like that, but there's only a few of them. And then the government, prices aren't really a thing. They work off budgets, so they'll tax. They can create their own money, so prices aren't really a thing. So it's kind of like an NA, not applicable. Barriers to entry, pretty low. In a monopoly, very high. In an oligopoly, very high. In the government, again, doesn't matter. So an example, free market would be like, you have just a variety of stores. You can open up a store, you can do whatever you want and sell it. In a monopoly, there aren't too many monopolies these days. Most things operate as an oligopoly, and the government doesn't really regulate it. So, but in the past monopolies, you had Carnegie Steel, you had Standard Oil, and the government was able to bust those up. But with oligopolies, you have a few players, like your major phone companies. You have AT&T and Verizon. You don't really have a lot of options beyond that. Cable companies for the area, what do you have? You have AT&T. I think Verizon provides internet, but they don't provide cable. I think AT&T provides cable. You have DirecTV, Comcast, and you may have like a couple of others, but they're an oligopoly. And then the government is, the government. So the government by the products that they basically, put out there, like a public road, a public park. Anything that says public in front of it is the government. All right, now we're going to talk about, so those are like market structures in terms of, the actual strict market itself, and they play together. You can have government with an oligopoly and stuff like that. Now we're going to look at business structures. So you have a sole proprietorship, you have a partnership, corporation, multinational franchise, and a nonprofit. So there's a lot of them there, but they're pretty distinguishable pretty easy. So sole proprietorship, that's just you making t-shirts in your garage. You don't have a partner. You don't have anything like that. So let's say you continue to make t-shirts, but they become popular, but you don't have enough money to buy the equipment necessary to produce more t-shirts. You can't keep up with demand. So then you have, you may bring in a friend who can help you produce, and you create a partnership, and however that partnership is structured, maybe 60-40 because you had the good idea and then they're helping you out. But you take their money and they put their money in the business you had, and you guys basically share the profits. A corporation would be, you sell shirts, but you also sell tank tops, you sell female shirts. It's just a huge enterprise. And now you expand into shorts, and you expand into hats and things like that. But again, you need a tremendous amount of equipment to get that up and running, so which means you need like a warehouse. You're going to need equipment to produce each of them. You're probably going to need employees. And at that point, you can keep your partnership. You can join more, you can bring in more partners, but again, they may not have the money to deal with the increase in expense. You may have to raise a lot of capital. So what you do is you become a corporation. And what a corporation does is they sell what's called stock, and to just anybody, anybody who wants to buy it. And they, with the sale from the stock, they take that money and they expand out, and then the profits get divvied up by the people who own the stock. Now, you're just stockholders. That's it. You become a stockholder, whatever partner you had becomes a stockholder, all of that stuff. So with a corporation becomes its own person. It's called corporate personhood. It has freedom of speech, freedom of press. It can petition governments. It has 4th, 5th, and 6th Amendment rights. It doesn't need the right to own guns. Well, if you need security, I guess you can. What else? You can sue. You can be sued, so that's the 7th. You can argue the 8th, the 9th, and 10th, and then discrimination. So, it's almost like the corporation itself has all the rights of a person. It can't vote, though. That's a biggie. If corporations could vote, we'd be in big trouble. Because forming a corporation for really rich companies ain't nothing. They can form 10,000, 100,000 corporations, and each one gets to vote. So, how are they going to vote? Now, one more thing about a partnership is, let's say that you're not making shirts. Let's say that you're doctors, and doctors take on a tremendous amount of risk when they operate. And let's say one of your partners kind of plays a little fast and loose, and a patient sues. You have what's called a limited liability partnership, or an LLC, limited liability company or corporation, or company, which basically means that it is a partnership, but if one of the doctors gets in trouble, it's not going to bleed onto you. It's all his risk. Then you have a multinational. Well, so let's go back to you making t-shirts. So you're making t-shirts, and you figure out that if you make your t-shirts in China, it's a whole lot cheaper and your profits increase. And that's something that, in a corporation situation, you're going to want. You want to keep making money every year, or you want your profits to go up every year. So, so that's pretty much it. Multinational franchises are kind of a different animal. McDonald's. You may think McDonald's makes burgers. They don't. What they do is you have each McDonald's locations, but McDonald's corporate doesn't actually make burgers. What they do is they attract people who want to open a McDonald's store in their name, give them a huge set of binders and say, this is what you need to do, and then you're going to pay us rent. And so really McDonald's is basically the biggest landlord in the world. That's how they make all their money. They don't make money off burgers and fries. They make all their money off rent. the money made off burgers and fries goes to the entrepreneur who opened the store. But again, he has to follow all the rules of, that's why like 7-Elevens are a franchise. Most all your fast food. In-N-Out isn't. In-N-Out is actually owned by a corporation. Trying to think of other franchises. Cell phone stores. Those are all franchises. Those are individually owned, and then they vend different products. And then you have a nonprofit. A nonprofit is exactly that. They're in a business, but don't think of it as business. They do all the things maybe a business would do, but they're not there to make a profit. So whatever revenue they generate from raising funds or asking for donations or something like that gets put back into their effort. Now, there is kind of something that some nonprofits have done, like Susan G. Komen. She's the one that created the I Heart Boobies bracelets and all that stuff, the pink ribbons. So the lady in charge, I can't remember her name, she kept giving herself raises because she was doing such a good job. So the people within the nonprofit can profit from their efforts. However, the company, the entity itself, can't turn a profit. You don't have stockholders or anything like that. But if you end up giving everybody raises, you're almost as good as a corporation. So you can kind of cheat the system. The advantages of a sole proprietorship, you get to make all decisions. The disadvantage is you take on all of the liability. If for some reason the inks that you use in the shirt give people a skin irritation, they sue you, you're the guy. You're the one that they sue. Another advantage is you can easily choose your product, so you can go in and out of business easily. You can switch. You're like, I don't like T-shirts anymore. I'm going to work on computers. You can easily switch from one product to another. A partnership, it brings in more capital. For you to, like I discussed, when you need more money to expand your business, so that's more advantageous. And then, of course, the same thing with a corporation. And then another disadvantage is you got to share your decision making with somebody else, and you got to deal with somebody else, and sometimes dealing with somebody else kind of stinks. Corporation advantage, you get a lot of capital. Also, if someone sues you, it's the corporation they sue. They don't sue the individuals within the corporation. So if your corporation gets sued out of business, you can reincorporate under another name and then just keep doing the same thing you were doing. Disadvantage is you got to continue making profits every year. And that isn't necessarily a disadvantage. It's just that it creates a situation where corporations aren't necessarily in it for making the product, they're in it for the money. And, that can cause some issues. Whenever we complain about corporations, it's because of that incentive right there, that they have to continually make profits for their stockholders. They're hard to start. Corporations are hard to start. Corporations are hard to start. It takes a lot of capital, really hard to manage. You got to be really good at business to manage a corporation. A multinational, it's all the parts of a corporation. You can save money by producing your product somewhere else. The disadvantage, really, it's all the disadvantages you have with a corporation. A franchise, so a franchise, you don't have to do all the heavy lifting. You have somebody else do it for you, making the burgers, making the fries, all that stuff. All you do is just go and collect the money from them. The disadvantage is you kind of give up a lot of control on your products, so you have to monitor and make sure that your franchisees, the people who own the franchises, are actually doing what you tell them to do. An advantage of a nonprofit, let's go with the disadvantage. You don't get to make a profit, so you have to depend solely on the feeling that you're doing a good job. And then the advantage of a profit, I think I talked about that CEO. That's kind of a low-down advantage. That's not really like a altruistic or a good advantage. It's more of like they took advantage. And another advantage of a nonprofit is, you get to do whatever. You don't have the same incentive as a corporation to make a profit, so you can continue doing the good work that you've always been doing. And I think I provided some examples, the T-shirt making, the Susan G. Komen. You have Nike, they're a multinational, they make their products somewhere else. Franchise, McDonald's, I gave you an example on that. Corporation, I mean like Walmart or something. Oops. Walmart or whatever. So I gave you some examples down here. So let's take a look at a corporate structure. So the owners of a corporation are the shareholders. They're the ones that own the corporation. Okay. And what they do is they elect or select a board of directors. Now the board of directors hires the president or the CEO. Whoops. There we are. Hires the president or the CEO. So let's just talk about this level real quick. So you have the shareholders, they own the company. They elect a board of directors who just oversee what the CEO is doing. And the CEO runs the company, but the board of directors make sure that the CEO is running the company how they see it. So the board of directors is the line between the shareholders and what the company is doing. So they can hire and fire the CEO and all that stuff, but the board of directors is acting on behalf of the owners. And then the president usually hires like a vice president, so they have a bunch of vice president in charge of different things. Like if you're selling a product, you have a vice president in charge of sales. If you're producing a product, obviously you got to produce something before you sell it. You have a vice president of production, and then you have a vice president of finance, because you got to make sure that, if you're in the business, you're always in the business to make a profit, so you got to make sure that you're actually making a profit. So sales, like where the sales taking place, domestic like at home or international, and then production, you have the actual production like the factory. I guess I didn't include that in the little bar thing here. Research and development, coming up with new products, and then making sure the products are actually safe and compliant. And then you have something like payroll, you got to pay your employees, and then you got accounts receivable, meaning like all the money you make, so that's your income. And then you have accounts payable, which is all of your costs. So, we owe an electric bill, we owe this, we owe that, those are your costs. And then you have a special department, payroll. It's funny, payroll always smells like pencils, or at least the accounting department always smells like pencils, because they teach you to use pencils in accounting. I guess it might be converting over to computers, but I remember back in the old days, business I worked for, you'd walk into payroll and it smelled like pencils. It's kind of weird. So a business franchise, we kind of already talked about that. You can go and pause it, and this is, I'm not going to really go over it. You just answer the questions yourself, and we'll answer them in class too. I like this about minimum wage. I used to work in McDonald's making minimum wage. You know what it means when someone pays you minimum wage? Your boss is trying to say, it's like, hey, if I could pay you less, I would, but it's against the law. So, that's kind of I don't know, I thought it was a clever way to interpret minimum wage. So you have the cost of labor, and we'll look at the cost of labor and all that stuff. So in America, if you take into account employee benefits, fair wages, misspelled vacation time, etc., all that stuff into consideration, iPads would cost $15,000 if they're manufactured in America. We keep a certain standard of living, but what does that say about the standard of living where other people manufacture our iPads? All right, let's take a look at types of labor. With unskilled, everyone is equipped with the ability to work. Anybody can do it unless, you are totally physically disabled. It's very low pay, so, a job at McDonald's, being a cashier or flipping burgers. Semi-skilled, it takes at least a high school education, so manager of McDonald's, usually maybe it requires a bit of college. And then some college or a bachelor's degree, so 4 years of college. A franchisee of McDonald's, so someone who owns, who partner with McDonald's and owns a McDonald's store. Master's degree or doctorate, this would be like an executive at the McDonald's corporation, somebody who oversees some part of it. So if you take a look at this graph right here, you'll be filling in 2 to 5, but give some examples of unskilled, semi-skilled, skilled, professional. You could probably throw cashier over into unskilled. The daycare employee would be semi-skilled, but the daycare owner would be skilled because they have to keep books or something like that. And then a teacher, yes, we are professional labor. All right, let's take a look at labor itself. So you see supply and demand curves. If you take a look at the questions and be able to answer this yourself, how many fast food chefs would the restaurant hire at a $10 wage per hour? So, you just track how many workers would be willing to be fast food chefs at the wage of $10. So here's the wage of $10. 4. So you're going to have to find an equilibrium. You may have to knock it back to 5 or something like that. What would happen if the restaurant tried to hire chefs? So you can go ahead and answer that question. Next one, how many fast food chefs would the restaurant hire at the wage of 15 an hour? So here's 15, and remember the demand. So right here, it's at 6. How many workers would be willing to be fast food chefs at the wage of 15 if the wage rose to 15? So here's 15, only 4, okay. So, go ahead and read that, and then what would be the result if the wage rose to 15 an hour? And we'll talk about that in more depth in class. What would happen if you take employees who were working at McDonald's, you had a bunch of employees who wanted to get their wages up to 15 an hour if they were working at $7.25. So if you double their wages, what would be the ripple effect of doing something like that? And this is how you determine wages. You take a look at how many people are applying based upon, what the deal is. Labor force by education. Here's what you earn. Okay, college is expensive, but at the same time, your earnings go up. So it's not necessarily your take-home pay is a tremendous amount, but it gives you the opportunity to earn more. Perhaps a few of you can go work in the trades and make a ton of money, but it is rare, and the trades are going to be evaporating soon, and I'll show you that in a bit. Education by workers, this is what you call a bell curve. It goes up, goes down. Less than high school is a high school dropout. We have some college, meaning like 2 years of college. That's 4 years, and then this can be 6 to 8 years of college. And then go ahead and answer these questions on your own. All right, let's take a look at the fastest growing occupations, 2016, 2026, so the next 10 years. What I want you to look at is what do most of these all have in common? You see wind and solar, but this isn't necessarily manufacturing, it's installation. So take a look in, we'll talk about in class, like take some guesses as to what categories of labor this is, and that'll give you a sense of how much money you make. This is more installation, so installation isn't necessarily a 4-year college degree. Declining occupations. So, what do you see again declining the most? Mechanics, word processors, typists, parking enforcement, respiratory therapy, and then locomotives, so trains. They're becoming more and more automated. And then if you take a look, what do you see about people in the labor force? You see men, you see women. Take a look at the gap right here, form some conclusions there. And then women in the labor force, this only goes to 2000, so I can tell you that this gap is closing here. And this gap is closing here as well. So add some, create some conclusions on why that is. And then if you take a look, when we talk about the wage gap. There is a wage gap, and I'll be presenting some evidence of that in class. Wage gap between men and women. The thing is, though, is one of the reasons for the wage gap could be the degrees that women choose. So you can see, like, the first 10 are mostly male dominated. And then you can take a look at the salaries, and the salaries decline as you go. So as you get down, so the average top 10 is 72% male, and it's 63,000 right there. And then you keep going, and it keeps declining, and you start seeing a decline in the amount of men who have these degrees and the amount of women who have these degrees. That can contribute to the decline in wage gap. But there is actually still, they did some studies that show that there is still a bit of sexism still with the wage gap. And then if you take a look at, and I define some stuff right here, primary jobs that create products from natural resources like mining, secondary products made from products from natural resources, so steel or steel beams and stuff like that, and then jobs that are service related, essentially. So you can see tertiary in 1950 is about half the economy, and now it's about 80% of the economy, and this is in 2000. I can tell you that secondary and primary are closing as well. So we're becoming mostly a service-based economy. And you can see that back here with the jobs. Are these more creating stuff out of thin air, or are these service-based, like software development? You're creating stuff on a computer. That's service. Statistician service. All of this stuff is service. This can be considered secondary, but honestly, this is a fast-growing job. So if everyone piles into wind and solar, it's going to fill up quick, and then those bars are going to reduce. And then we're going to talk about union membership, and we'll talk about union membership also outside this unit. I think unit 6 when we look at economic measures. So, answer the questions as you go. And if you take a look, hourly wages, they're bigger, but they're not covering as much. So here's current dollars going up, but constant dollars, meaning if you take a dollar from 1964, what would it buy in 2018? And it's been pretty flat. Now that's just pay. That isn't necessarily healthcare, in which case Americans have been getting paid a lot more because healthcare is really expensive. And that ends it for this unit.